Welcome back to another episode of The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you, it cannot take care of itself. Today, keeping on the theme of Asia, there have been big market declines, not just in Asia, but around the world. I thought we'd look at HSBC, the global banking giant that until 2007 was the darling of Wall Street, every exchange really. HSBC, the stock climbed up to about $100 a share. It had branches and full operating banks in most markets around the world. It was a success. It was riding high. What happened? We had the recession in 2007, 2008, which just hurt HSBC badly. Then we had a series of regulatory issues, all sorts of capital requirements and other things which bit into HSBC's operating businesses. Where they're located? 40% in Asia, 30% in Europe, some in the United States, a little bit in Latin America, not much in the Middle East. It's been a great success story in terms of putting bricks on the ground. It hasn't been in terms of its financial management. What are the other problems? Well, you can see on the chart. Here it's almost $100 a share, and right now, well, we're down here at 39. This is the ADR, but you can translate it through to British pounds if you're more comfortable doing that. So it's cut in half, by more than half in the last 5, 6, 7, 8 years. Not a good story. Is it a buy today? Well, it has some good things. It's below book value, so there's a bit of a cushion there. Although if you don't like the assets on the balance sheet, that's no cushion. The market cap for a bank like this, $152 billion, I think is a bargain. To buy the whole HSBC global franchise for $152 billion, to me it sounds reasonable. They do generate a lot of revenue in their markets, and they have good people who work for them. I hope some even watching this program. The question is, when do we want to buy HSBC? I look at banks this way. A bank that has a good control of its costs globally is going to be a winner. A bank that's lost control of its costs, probably less so. Where are the costs today for HSBCs? The so-called efficiency ratio is over 50%. I would even say it's getting closer to 60%. If you can drive that number, you watch that number fall into the 40s, 48, 49%, and you watch the return on equity climb over 10%, it'll tell you two things. They've got control of their costs, and they're getting good high margin business in their banks around the world. Before that moment, I'm gonna take a wait and see attitude on HSBC. That's all the time we have today on The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you. It cannot take care of itself.